Alright, so in this video, I want to talk about my 2020 investment strategy. I've been through a lot through the years. I've changed my strategy several times, and this is the strategy that most likely, I'm going to say 99%, that I'm going to end up keeping for forever after learning a lot, after making a lot of mistakes, making a lot of costly mistakes as well. So this is a strategy that I'm going to stick to in 2020. I'll show it to you quickly, and I'd like to elaborate first on the process on how I got to this strategy, and then I'll explain the strategy itself. So just to let you know what it is. So in my margin account, I'll be doing put credit spreads on the SPY only every Monday, Wednesday, and Friday, 30 days to expiration. So I'll elaborate on the details after. In my registered account, so Tfsa, Rrsp, Resp, I'm going to be doing out of the money weekly covered calls on ETFs. ETFs like the Qs, IWM, and the SPY. All right, so let me explain how I got to this strategy. So I started investing on the stock market or trading on the stock market in 2009 when the market crashed. It caught my attention. I had a bit of money. I think I started with $5,000 in a Tfsa. And I opened an account with Questrade. Questrade was my first broker. And I remember I started day trading. So the first thing I did was day trading. So buying stocks and selling it the same day for 1 to 5% gains. Obviously, I wasn't doing the full analysis or looking at trends or looking at moving averages or reading candlesticks or anything like that. I was just going based on intuition. This chart looks like it's going to go up now. This looks like it's going to go down. And I got lucky a few times, so I thought I was good until, of course, I got burned. Then I realized day trading was too stressful and it wasn't for me, especially that I wasn't even doing it the right way. But regardless, that's how I started off. I remember my first day I had 3 trades of 5% gains each, but that didn't last long. I don't know why it never came to mind to just buy one stock and hold it forever. That never crossed my mind. For me, the stock market was about making money right now, using your money to generate income so that you can live off that income right now. It wasn't about investing and growing your money. In my eyes back then, it was more about generating profits right now to spend. And then I came across options. So my background is accounting, so I'm comfortable with numbers. So I had no problem learning all this on my own, just from YouTube or internet. Came across options. It made a lot of sense to me. I liked the leveraging power and that you could double or triple your profits easily if you get the direction right and the timing right. So that's what I did actually. So with $5,000, I bought call options on, I remember Citigroup was one of them. I don't remember the others, but I remember Citigroup was one of the call options I bought. And in 3 months, I doubled my investment to 10,000. So from 5,000 to 10,000 in 3 months with call options. And then from 10,000 to 14,000 doing the same thing. Just with call options. I remember one of them was Barclays as well. And one of them was actually a 50% gain in one day. And then once I had 14,000, I was continuing the same way. Then I started buying BP call options, and then I just had several bad trades in a row, and that 14,000 became $6,000 in 1 month. So I was very disappointed, of course, that I erased gains quicker than I made them. So then while I was going through all this, I realized that when a stock drops, eventually it comes back up. You don't know how much time it takes to come back up, but eventually it comes back up. So I decided to swing trade. I had more success swing trading. I felt like I was good at picking the bottoms just based on intuition, and then I would hold the stock for a bit, and then I would end up selling it for a small profit, whether it's a month, 2 weeks, or 3 months later. So that actually went well up until 2 years ago. About at the same time though, I wasn't consistent in contributing to my accounts. I would often withdraw money, so wasn't really stable in investing and trading. I didn't have the money to contribute to my accounts. But whenever I did make a trade, a swing trade, I would end up making a profit on it. And then I think it was in 2018 that I realized, or maybe not necessarily realized, but I kept falling on stocks that would not necessarily go up over time, even if, so most of the stocks that I would buy when they drop, eventually they come back up. But then in 2018, I started realizing that I wasn't consistent at picking the bottom of these stocks. So a lot of the stocks I bought that I thought was a good price just kept dropping and dropping. One of them was Kraft Heinz that I bought at $75 because it was trading in the 90s, and then when it dropped to 75, I thought it was considered low, so I bought it just based on intuition, based on the chart, and then it just kept dropping and dropping and dropping. I don't even know what it's trading at now, probably in the 30s. I did that with GE as well. Did that with HBC. Did that with Cenovus Energy. Did that with Enbridge. Although Enbridge did end up coming back up, but almost after a year and a half or 2 years. And in 2017, 2018, my strategy was to swing trade dividend stocks. So even if I ended up not calling the bottom correctly and I had to wait longer than expected, at least I would be collecting dividends while waiting. So that was my strategy, to swing trade stocks that pay dividends, so that in case I have to wait longer than expected, I'm getting something out of it. And then I came across Alan Ellman videos on covered calls. And I thought I landed on something amazing, which was you buy 100 shares of a stock that gives you the right to sell calls against your stock. You're able to sell stock. You're able to sell calls. So instead of buying calls, you can sell the calls and collect the premiums up front, as long as you own 100 shares of the underlying stock. So for example, if I buy 100 shares of a stock at $30, I could sell a covered call right away. I could sell a call option at a 30 strike, expiring in 30 days, and I can collect a premium of $2, for example. So the consequence of that is, after 30 days on expiration date, if the stock is trading above my strike price of $30 that I sold the call option at, if the stock is trading above my strike of $30, I have to sell my shares at $30. So I lose my shares at $30. But in return, I got paid $2. So if I'm okay with that, then this is a great deal for me, because I just made $2 over 30 in 30 days. So that's 6% in 30 days. And I got my money back. And guess what? I'll do it again. Look for a stock, sell a call option at the same strike that I purchased the stock at, collect the premium. I don't care if I lose my shares at the same price I bought it at. I got the premium out of it in 30 days, get my money back, do it again. And I'm thinking 3 to 6% per month is very good. That's at least 20% or 30% per year. Plus every month I get my money back. So that was working well, especially when stocks kept going higher. So definitely I got my money back and I got my premium, so I didn't care. And it worked well until it didn't. And what happened was, sometimes I buy a stock at $30, I sell that call option at $30, collect a $2 premium, but then the stock within 30 days drops to $25. So now I'm stuck holding a stock that I'm down $5 on just to collect a $2 premium. And now if I try to sell a call option the next month, there's no premium at the $30 strike. So I have to go lower. I have to sell at a lower strike if I want to collect some call premiums from it. But remember, when I sell that call option, the consequence is, the trade-off is, if at expiration the stock is trading above my strike, I have to sell my shares at that strike. So if I initially bought the stock at 30 and the first month I sold a call option at 30 strike, collected $2, I'm good. The stock drops to 25. I'm forced to sell a call option the next month, let's say at 27, just to get some premiums out of it. Then there's a risk that I might lose my shares at 27. But I don't want to lose my shares at 27 because I paid $30 for the stock. But that kept happening, but on a bigger scale, in the sense that I would buy a stock at $75, the stock would drop to $35. So now there's no way I can sell a call option at 75 strike. I have to go all the way down to 40. So now the whole time I'm afraid to lose my shares at 40 when I bought the stock at 75. So yes, I collected some decent premiums at the beginning of the first month I sold the call option at, but then but I'm holding a stock that's down $40 times 100 shares. So that kept happening over and over again. And the reason for that is, of course, I was running after the premium. So when I discovered covered calls, I was looking for stocks that had high premiums. Not all stocks have the same level of volatility, so the premiums are priced differently. Since call options is a type of insurance on a stock, every underlying will have a different level of insurance. So some stocks, the riskier stocks, will have higher volatility, so their premiums will be worth more. So I ended up running after or chasing the premiums. So I ended up buying low quality stocks that were riskier just because the premiums were higher. And eventually I would end up holding a stock that was down 30, 40, sometimes even 80%. Just because I was chasing the premiums, thinking that it's okay, I don't care if my stock gets sold, I'm collecting high premiums anyways. But eventually the stock dropped more than the premiums that I collected. So even though I was chasing bad stocks just for the premiums, I realized that even quality stocks can still fall. Even if you buy them at prices that you think is fair, it could still fall, and then writing covered calls on them would not work anymore because the stock dropped way lower than your purchase price. Since I'm really passionate about the stock market, I keep watching videos and learning new things. Then I discovered option selling strategies. So instead of buying options, I discovered selling options. Similar to covered calls, but strategies that do not require owning the stock. Strategies like credit spreads and iron condors. So what I like about these strategies is you don't have to necessarily know where the stock is going or guess the direction of the stock. You can still make money every month as long as you give a range to the underlying stock. So as long as the stock moves within a certain range at expiration or stays within a certain range at expiration, you can make money. So that, to me, the concept made a lot of sense because I don't want to guess where the stock is going. So the basic way of making money in the stock market is you buy a stock low, you sell it higher. But that means you have to guess the low in order to sell it higher. But with credit spreads and iron condors, which are option selling strategies, you just have to give the stock a range that it will land on expiration date, and you can make money, and that range can be wide. So for example, if a particular stock is trading at $30, you could place an option selling strategy that says as long as the stock stays between $20 and $40 at expiration, I'll make $50. If it doesn't, I could potentially lose, for example, $450. You could control the level of profit you want to make up front and your max loss as well. If you get closer, if you have a tighter range, for example, the stock will stay between 25 and 35 come expiration, you're going to collect more profit, but then you have a smaller chance of winning compared to the first scenario. So the reason I'm going through all this strategy is because it really will explain why I ended up with the current strategy that I have right now, which is put credit spreads on the SPY in my margin account and out of the money weekly covered calls on ETFs in my registered accounts. So what I liked about credit spreads and iron condors is it was all about probabilities. Before going into a trade, you knew the probability of winning. For example, going into a trade, you knew that this particular stock had an 80% chance of staying within that range come expiration. So if you know there's an 80% chance that it stays within that expiration and you're collecting, I don't know, let's say $100, that means there's a 20% chance that the stock trades outside of that range at the expiration. And let's say you would lose $400 if the stock is trading outside that range, then you have to see if it makes sense placing this trade, because you have a 20% chance of losing $400, but you have an 80% chance of winning $100. So in the long run, the more you place these trades, do you have an edge? Are you going to win at the end? 80% times $100 is $80. 20% times $400 is $80 as well. So in the long run, I'm going to break even if I keep playing, if I make this trade with these prices. So it was simple math, really. So the concept makes sense, but the approach is what can differ from person to person, from trader to trader. For example, I made a lot of mistakes with that concept. It makes sense, but I used it incorrectly. For example, if the stock goes up a little bit, in my mind, okay, it went up already, it's not going to go higher. I would then sell a call spread, even if the probabilities don't make sense. So I have the probabilities given to me, and I wasn't collecting enough credit based on the probabilities, but I would still place the trade. So I ended up again losing a lot of money with that strategy. But like I said, I learned a lot, lost a lot of money, but gained a lot of knowledge, and this is what brought me to this strategy over here. Now I have a video explaining why I went with this strategy over here, but basically I'll go through it quickly. But I realized that I downloaded the historical prices of the SPY, which is the general market, on Yahoo Finance. And I realized that if you look at the SPY on a particular day, there is a 65% chance that 30 days later, the SPY is trading at the same price or higher. So that's an edge. That if on May 1st, for example, SPY is trading at 300, there's a 65% chance that May 30th, SPY is trading at 300 or higher. So that's an advantage. That's an edge. There must be a trade that allows you to take advantage of that information. So that trade is a put credit spread, because you can collect credit by selling a put lower than 300, collect money, and as long as the SPY is trading above that put come 30 days, you keep that money. So remember, I said that if SPY is trading at 300, there's a 65% chance that it's trading above 300 in 30 days. But what if I sell a put at 280 or 290 instead? I'll collect a smaller premium, but I have a higher chance, maybe 80-85%, that the SPY will be above that short strike of 280 or 290 come 30 days. Plus, I don't have to wait 30 days. I can close the trade earlier if I can for 50% profit, because as time goes by, the option value decays. So if I sold something for $80, I can buy it back for $40. So I don't have to wait till expiration and risk that the SPY drops below my short strike for whatever black swan event. All right, so if I look at my account, you can see that this is my margin account. I've got right now 4 open positions, and I grouped them by strategy so I could see the put spreads. So I've got May 18, May 15, May 13, May 20 expirations. I've got 4 put credit spreads on the SPY. The only reason I have 4 right now is because I wasn't able to close them for 50% profit. Some of them are close. This one was close today. It's showing me a small profit already. 239 minus 208 is my profit, but they're not 50% profit yet. And as you can see, for example, I sold a put spread expiring May 13 at a 250 strike. So when I did that, I think the SPY was at 270. So as long as the SPY trades above 250 come May 13, I keep my full premium of about, I think I collected 78 or 80 something cents here. 88 cents. I collected $88 on this trade. But what I'm trying to get at here is the probability of winning. There's a good chance that the SPY stays above 250 come May 13. I don't have to guess the direction. I don't have to guess where the SPY is going tomorrow or next week. The SPY could move around, could fool around between 250 and 300 as long as it stays above 250 come May 13. So that's what I like about it, is that I don't have to worry about what the SPY is doing. Do whatever you want, SPY, but just stay above 250. I make the same amount of money anyways. And I like doing it in a margin account. Anyways, I can only do it in a margin account, but the advantage of doing it in a margin account is that it's an option selling strategy. So you're collecting premium up front for the strategy. So it's not using interest in the account. You're not borrowing money from the account. Money's actually coming into the account. But then you have to pay to close it, but hopefully you're going to pay less than what you collected. So it's not going to matter anyways. You're using the money that you collected to pay for the trade to close it, or you can let it expire worthless at expiration. So if you do nothing and the SPY is trading above May 13, if the SPY is trading above 250, above your short strike, come May 13, the options will just expire worthless. You keep the full premium and you don't have to pay to buy it back to close it. But I like to close it at 50% just to avoid the risk, because as you've seen in 2020, the market can do crazy things. So why every Monday, Wednesday, Friday? So if we look at the SPY, you can see that it has expirations every Monday, Wednesday, Friday. So you can see the expirations here, April 20, April 22nd, April 24th. So it has expirations every Monday, Wednesday, Friday. So every Monday, Wednesday, Friday, I'll sell a put credit spread on the SPY, 30 days to expiration. So I'll go for 30 days out. Why 30 days? It gives me time to manage the trade in case it goes against me. It also allows me to go further away. So for example, if the SPY was trading at, today I sold a put credit spread here May 20th. I sold a put credit spread at a 255 strike when the SPY was trading at 283. So it allows me to go almost 24 points away and I collected $80 on this trade today. So I collected $80. My max loss is $420. But for me to lose $420, the SPY needs to trade below 250 come May 20th. But by the it's not going to jump, or I can't say that because it has happened, but it's not overnight. I'm not going to find the SPY below 250. It's going to gradually drop below 250 if it does drop below 250 come May 20th. So by the time it's dropping, I'm going to be mitigating the maximum loss. I'm going to be selling call spreads on the other side to reduce max loss in case that happens. But most of the time in a regular market or bull market, usually the put side, the short strike on the SPY does not get tested often, and I'm able to close the trade for 50% sometimes in 1 week or 2 weeks. I don't have to wait the full 30 days to close the trade for a profit. Let's say February, I open a put spread 30 days out. So the expiration would be March. And February, the SPY was trading at 324. So let's say my put spread would have been at around 318. So come March, you could see that SPY was at 296. So that put spread would have been a loser. But between February and March, the SPY went up, and time went by. So for sure, I would have been able to close that put spread for 50% profit. Hence the advantage of managing your winners at 50%. Because if I had kept it till expiration, it would have been a loser. But if I close it at 50%, it becomes a winner. All right. But remember, I'm selling one every Monday, Wednesday, Friday. So this first one here would have been a winner, 50% profit, because I would have been able to close it maybe after a week because SPY was going up and time was going by. But then the next one here, February 4th, for example, I'll go till March 4th, 30 days out. SPY is at 329. I'll probably sell at around maybe 320. And of course, SPY is not at 320. It's at 297. So that one would have been a loser as well if I had held it till expiration. But I would have closed it at 50% before getting there for sure. But let's look at this one here. This one never had a chance. So if I had sold a put spread on the SPY when it was trading at 333, which I think I did, let's say I would have gone to 325 short strike. So 30 days later, so I'm at February 21st, so that would be March 21st. Let's see what the SPY was trading at March 21st. It was trading at 228, so big time loser, had no chance. But what would have happened is March 21st, my short strike is 325, let's say. So the next day, SPY is dropping. It's dropping fast, and in a week, it's at 312. So it actually dropped below my short strike. At that point, I start selling call spreads on the SPY with the same expiration of that spread. So I'll be selling call spreads, let's say at 335, 340. So I'll be selling on the other side. So when you sell a call spread, you don't want the stock to go above that call spread. When you sell a put spread, you don't want the stock to go below that put spread. But now I can't lose on both sides. I either lose on the put side or I lose on the call side. So I'm already below my put side. So I'm selling call spreads as a hedge to reduce my max loss. Instead of losing $420 on the trade, I'll be losing less on the trade because I'm selling calls, collecting premiums basically for free because I'm already on the other side completely. So that's what I would do with a trade that goes bad, is selling call spreads to reduce max loss. But as the SPY is dropping, guess what? I'm selling Monday, Wednesday, and Friday. So my next put spread that I'm going to sell is going to be even further away because as the SPY is dropping, that means there's volatility in the market. That means VIX is higher. So that means the premiums are higher. So if the premiums are higher, then I can go further away and I could collect more premiums. So as the SPY is dropping, let's say at 312, now I can probably go to 295. So I'm even further away for my next put spread, collect maybe a little bit more premium. But then 30 days later, that one would have also been a loser. But we did also go through a historical crash as well. But it's great that I'm showing you this example because I'm showing you how powerful this strategy is, even in one of the worst crashes of history, or in history. So at this point here, when the SPY is at 312 and I'm selling a put spread at 295, it's also going to become a loser. I don't know it yet. But as the SPY is dropping and going below my 295 strike, actually I might have had a chance to close it here for a profit. So look at this. So February 25th, SPY is at 312. I'll sell a 295 put credit spread on the SPY. And as you can see, the SPY is dropping, goes to 297, but it doesn't cross my 295. Goes to 296, doesn't cross my 295. Then it comes back up to 308, 300, 313. At this point here, about a week has gone by and the SPY is trading at 313. It's trading at the same price when I initially opened that put spread. So most likely I'll be able to close this put spread for 50% profit. So that put spread could have been a winner if I managed it at 50%. But if I did not close it, the following few days I would have regretted it because then that put spread becomes a loser. But that's fine. As soon as it breaches my short strike of 295, I'm going to start selling call spreads on the other side to reduce max loss. And I'm still selling a put spread every Monday, Wednesday, Friday. So my new put spreads become even more powerful or have a better chance of winning. So let's go all the way down to here. Let's go all the way down here to 270. SPY is at 270. My put spread on the SPY at this point will most likely be at maybe 30 points away. So let's say 240. And this is March 13. So let's look at April 13 where the SPY is at. April 13 SPY is at 275. So that one would have been a complete winner. So as you can see, even during a market crash, put spreads could still become winners. You might have a period where you're losing money. That's why there's an approach to it. You don't want to put all your capital in. You always want to leave at least 50% of your portfolio in cash because there will be periods where you need the money to fund the losses temporarily, but eventually the strategy becomes profitable because the higher the VIX, the more premiums you're collecting, the better chance your put spread has of winning because you're going further out. At some point, I had a put spread on the SPY at 180. So look at this point here. The SPY was at 222. Even before this point, I think when the SPY was at 240, I had a put spread on the SPY at 180. So that one for sure was a winner. The SPY never dropped below 200, never dropped below 215 actually. So I was able to close that one for a 50% profit for sure. And then after that, if I keep selling Monday, Wednesday, Friday, only these put spreads over here, like from here to here maybe, would have become losers. But I would have mitigated those losses by selling call spreads. So they would have become losers, but maybe not big losers. But then those ones after are winners. Even during this crazy market crash, I only had a short period where these put spreads were losers. And then the rest here become winners, as you could see here. Because when the SPY is trading at 270, I'm not selling a put spread at 270. I'm selling it lower. And I'm still collecting $90 or $100 if I'm doing one contract. And I close it for 50% when I get the chance. Every Monday, Wednesday, Friday. Now, I did make a mistake during this crash, or right before the crash. As I was successful with this strategy, I decided to increase my contracts. I was doing one contract before, and just right before the crash, I decided to do 3 contracts every Monday, Wednesday, Friday. So in a contract, if I sell a put spread 5 point wide, so the difference between the short strike and the long strike is $5. That means, let's say I'm collecting $1, my max loss is $4. So times 100 shares, that's $400. So I was doing 3 contracts. So basically, if I'm collecting $1, I'm per spread. So I'm collecting $300 up front, but my max loss is $1,200 every Monday, Wednesday, Friday. And I started doing that right before the crash. I think I had 1 week where these put spreads were successful. I was able to close them for 50%. But then the following put spreads were complete losers. I had a put spread on the SPY at 328. 328. So that one had no chance of winning. All I could do is reduce that max loss by selling call spreads. So that's one of the mistakes I made, is that I didn't sell call spreads fast enough. I actually had hope that the SPY would come back up, so I didn't want to decrease my chance of being able to close my put spread for a profit by having a call spread against it. So I didn't sell the call spread fast enough. So I missed out on the opportunity of reducing max loss by not selling that call spread. So that's one mistake I made. And the other mistake is I increased my size when my account didn't support it. I couldn't afford doing 3 contracts a week, but because I was greedy, because I was doing well, I wanted more profit, so I increased my size when my account can't handle the extra size. So that's another mistake. And then the other mistake I made was my strategy initially was every Monday, Wednesday, Friday, but as the SPY was dropping hard, I was selling put spreads the same day. So I would sell one in the morning and sell another one in the afternoon, because in the same day the SPY had dropped a few points and I wanted to take advantage of that drop, because I know when the SPY is dropping, my next put spread has a higher chance of winning and has more premiums that I can collect. So I was selling 3 contracts in the morning and 3 contracts in the afternoon. So I went from 1 contract every Monday, Wednesday, Friday to 3 contracts every Monday, Wednesday, Friday to 3 contracts sometimes twice a day. And then I would sell it the next day as well if the SPY continued to drop, which it was because we were crashing. So I didn't stick to my plan of only selling Monday, Wednesday, Friday. So by increasing my size and selling too often, too quickly, I ended up losing way too much money with these put spreads, because SPY was dropping like an arrow or a falling knife. But now I'm back doing put spreads, and I do realize that they do have a chance of losing if we go into a crash, a second dip. They could potentially lose, but I will manage them better. I will stick to the plan of selling call spreads. As soon as the short strike gets breached, I'm going to sell call spreads, and every Monday, Wednesday, Friday, I'm going to sell a new put credit spread on the SPY with a new expiration, giving it a better chance of winning. I do acknowledge that I might lose a bit of money while I wait for the SPY, or when the SPY reaches its bottom, but over the long run, this strategy usually will be profitable because it has a high probability of winning. And I've already closed a lot of put spreads for 50% profit already since we started recovering. And I've got one that's borderline ready to be closed for 50% profit. And what's great about this strategy is once my account size permits it, I can start scaling easily by adding contracts. Instead of doing 1 contract, I can do 2 contracts. It's the exact same trade, same effort required, same time required. Instead of selling 1 contract, I just click on 2 contracts. As long as my account size allows me to fund the periods where I'll have to lose money on these put spreads. So that's for my margin account. Now in my Tfsa, which is a registered account, I'm doing covered calls on the Qs. So the Q is an ETF that tracks the NASDAQ index. NASDAQ index is the index that contains all the quality tech, big name tech companies like Apple, Microsoft. So super safe. And it's got really nice premiums. It's got a lot of strikes. It's got weekly options, a lot of volume. So what the plan with this is, I know that the Qs or the indices go up over time. No matter what, they go up over time. Yes, they can drop. Yes, they can crash. But over time, indices go up. So as you could see from 2002, it was at $23. Now it's at $212. Over time, the general market goes up. That's the only thing we know for sure, is over time, the general market goes up. So given that information, I want to take advantage of that. I want to participate in the capital appreciation of the general market. So if I just buy and hold the Qs alone, it's not enough. I don't think buy and hold is a good enough strategy, because you will go through periods, sometimes 10, 15 years, where you get absolutely no gains if you just held for 15 years without doing anything. So buy and hold is great, but it has to be complemented by something else, either dividends or, in my opinion, covered calls. So for example, let's say you did not buy the Qs yet and you wanted to get into the strategy. So if we look up the Qs, if you buy 100 shares of the Qs, that's $21,000 US right now. Now, Qs have weekly expiration. I would sell a call. April 24th is the next expiration. And as you can see, at the 216 strike, I can collect $220. But of course, remember when I said what I said about covered calls, when you sell a call option at a particular strike, you risk losing your shares at that strike come expiration. But I want to hold my shares forever. So if I want to hold my shares forever, that means I don't want my call strike to get tested. I want the stock to stay below my strike. So the idea is to pick a strike that's far enough from the current market price. So if the Q is trading at 212, let's see how far I can go. So if I click all strikes over here and go, right now we're at 212, maybe 225. Let's see what I can get at 225. At 225, I can get $28. That's for April 24th. So if I think that by April 24th, Qs will be trading below 225, I could sell this call option, collect $28, and I still own the Qs, and I'll keep that $28. So you could consider it as an extra dividend, a kicker. So 28 cents divided by 212 is 0.13% per week. If I multiply by 52 weeks, that's 6.8% per year. Annualized, that's a 6.8%. That's if I'm selling the 225 strike. But I could sell the 224 and collect 37 cents. I can sell the 223 strike, collect 49 cents. So right now, I think with the Qs at 212, I think maybe by the end of this week, so by Friday, I think 220, maybe 222 is safe. Personally, I would go as far as I can. So I would probably sell the 223 just to be safe. Let's see what that gives me. 223 at 49 cents divided by 212. That gives me 0.2%. So times 52 weeks, that's 12% per year in call premiums collected, in addition to any capital appreciation the Q gets during that year. And even if the market drops, well, you're definitely gonna be keeping these premiums that you're selling because the market is dropping. So your calls are not getting tested. So at least you're gaining something, you're getting something out of a falling market. The problem with covered calls is if we go through a crazy bull market, or like, for example, last week or the week before, the Qs went up, I think 10% in 1 week. So that doesn't help covered calls. And in fact, here's the situation that I'm in. So if you look at my position here, I've got 134 shares of the Qs at an average price of 221. So my cost is 221. Right now, the Qs is at 212. But when the Qs was trading at 180 or 190, I believe it was trading at 190, I sold a call option in the same week. I sold a call option at a 199 strike, collected whatever I collected, I think $30 or $40. But then the Qs ended up closing that week at 201. So it ended up closing above my strike of 199. So that means I have to sell my shares at 199. But my cost is 221. So I don't want to lose my shares at 199. So what I had to do is buy back that call option that I sold. But because I don't want to lose money, I ended up rolling it for the next week. I sold a call option for the next week at a higher strike. I think I sold for 203 strike. And I was able to do that for a credit. So the net combination of buying the covered call and selling the next week's covered call was for a credit, I believe, of $30. So what that does is it gives me an extra week for the Qs to relax and come back down, because it just went through an exaggerated week. So it should come back down the following week below my strike of 203. That didn't happen. It continued to go higher. Qs is at 212 right now, and I had to roll the call option again last week. So now I have a strike of 204, as you can see here. I was able to roll it for a credit, but once again, it expires April 24th, so it expires this Friday. I don't want to lose my shares at 204 because my cost is 221. So most likely I'm going to end up rolling it again. I'll try to go to 205 or 206. In fact, I already have it up here. So as you can see, I could buy back the call option at 204 strike, and I could sell the May 1st, so next week's expiration, 207 strike. I could actually do it for a very small credit. I could do it for about maybe $10 of credit, but it allows me to go to a higher strike, make my trade safer, get closer to my cost, because to avoid losing my shares at a price that's lower than my purchase price until the Qs come back down, because this is exaggerated. It had 2 crazy weeks of gains. It should come back down. If I want to go for a 206 strike instead of a 207 strike, I can collect about $70 out of this trade. So I could do this, I could roll it forward for a credit. So if I look at my executed trades on the Qs for the past 3 months, you can see that I keep collecting credits on the Qs. Even though I'm rolling forward the call option, I'm doing it for a credit. So $60, $50, $40, $30, $28, $35, $35, $39. This is every week. $25, $1.20. Or $120, sorry, $125. So this is the advantage that I find of writing covered calls, is that buy and hold alone is not enough. You have to add something, in my opinion, either dividends or selling call options. So I like to sell call options, but there's obviously different approaches. That's where you might hear someone talk about covered calls saying that it doesn't work, you'll always lose. It depends on the approach. It depends how you sell them. So I think selling weekly out of the money, so as far as possible, so to give yourself the best chance that you don't get called away. That, I think, in my opinion, will beat the general market. It's less of a headache as well. You're collecting income. You can spend this income if you want. So you can see it as a dividend. And obviously, depending on where the VIX is, when the VIX is high, premiums are higher. So when volatility is higher, you can go further out and collect more premium. When VIX will be low, you probably won't be able to go that far. So if Qs is at 212, you'll probably have to go to 215 to collect something. But if VIX is low, it also means that volatility is low, so stock should not move that much anyways. Plus the other thing I could do, so right now I'm selling weeklies, but in the past 2 weeks, the Qs managed to move a lot in 1 week. What I could do is wait till the expiration date. So I could wait till Friday morning and just sell a covered call on Friday. So if the Qs open, let's say at 215, I know that on the same day, it's not going to move much on the same day. I could sell a call option at 218 or 217, collect $30 or $40. What would be even great is if I can buy 100 shares of the SPY. Because the SPY has 3 expiration dates in 1 week, I could sell call options on the SPY every Monday, every Wednesday, and every Friday. And that increases my chance as well of not getting called away, because I'd be selling on the same day. I don't have overnight risk. The risk with covered calls is overnight risk. You don't know what happens overnight. The SPY, your underlying stock can open much higher or much lower. So to avoid that risk, if you can sell on the same day, that would be even better. That would be ideal. So for example, if I had 100 shares of the SPY right now, today was an expiration, but it's already past 4 o'clock, so I can't really. But if we look at the next expiration, which is April 22nd, which is 2 days away, but then I have 2 overnight risks. At 285, I can collect $168 in 2 days. Obviously, I'm going to go further than that because I want to increase my chances of keeping my shares, and I don't want the stock to trade above my strike. So let's say I go to 295 if possible. So 2 days away, I could probably go to 291, collect $37. But what I would do in that case, if I did own the SPY, is that I would wait till Wednesday, see where the SPY opens at, and then sell a call spread a little bit higher on that day. I think it increases my chance of not getting called away. In my Rrsp, same thing, but I'm doing it on IWM because I didn't have enough capital to do it on the Qs or the SPY. So it's the exact same idea, but I'm doing it on IWM, which is the index or the ETF that tracks the Russell 2000 index, which is all the small caps. So pretty safe over time. Russell 2000 always goes up over time. And this ETF also has good volume, good option volumes as well. So right now my cost is 151 and the ETF is trading out 120, but I've got a 124 strike expiring this week. So see, this one I'm doing a little bit better. It's safer because I've got a 124 strike expiring this week. So it's safer than the Qs. The Qs, I'm already in the money with the Qs, but with this one here, I'm still out of the money. My strike is still out of the money. And if it does end up reaching 124, well, I'm just going to roll it forward to the next week. In fact, let me show you. If I wanted to roll it forward right now, I click create order, remove the shares. I would have to buy back the current call option, and then I would sell the next week's call option, May 1st, at, let's say, at a higher strike, let's say 120, 128. And I could do it for a very small credit, but I'm increasing my chance of not losing my shares at a lower strike. So let's say I go to 127 just to get a nicer credit. So at 127 strike expiring May 1st, I could collect about $40. $40 on a position, on a price of, what is it trading at, 120 or 121? So 40 divided by 121 is about 0.3% times 52. Times 52, that gives me 17% annualized return. Now, my RSP, because I don't have enough capital to do 100 shares of the Qs, SPY, or IWM, I just ended up buying Dell because I like Dell as a company, as a product, as a consumer. And I'm doing the exact same thing, but on one stock. So bought Dell at 39.66. It's trading at 40.96. And I'm just selling covered calls every month. Dell does not have weekly expirations. It has monthly expirations. So this expiration here is May 15, 40 strike. Collected, here, let me show you. Executed, and I'll filter on Dell. And you can see that since I bought Dell, see, initially I had a 45 strike. I collected, I don't remember how much I collected. I think I collected $50 initially. And then I brought it down when Dell dropped. I brought it down. I collected another $90 for the same expiration. So for the first trade, for the first month's expiration, I collected about $140. And then the second, and then April 17 expiration, collected $124. And then May 15 expiration, collected $170. And I still own the shares, and I'm not down on the shares. Bought it at 39.66. It's trading at 40.96. So I'm not losing money on the shares, and I've been collecting premiums on the shares as I just mentioned right now. And any leftover balance I have, I just buy MasterCard or any quality stocks like MasterCard. Let me show you a list of the only stock that I'm willing to buy right now is American Express, JP Morgan Chase, Visa, MasterCard, Coca-Cola, McDonald's, Apple, Microsoft, Walmart, Costco, the SPY, IWM, and Q's ETF, of course, and Facebook. These are the only stocks that I'm willing to put money in. All right, so this is my 2020 investment strategy. I hope you've made it this far, but I just really wanted to explain the process and let me know what you think as well. I'm open to all feedback, seriously. As you can see, if you've been following me for a while, you saw that my strategy changed often. This time though, I don't think it will change. If it does change, I'm going to go to dividend investing. I'm just going to buy quality dividend stocks, reinvest the dividends, never sell them, and just eventually in 20 years, I guess, I can live off the dividends. The only reason I'm not doing dividend investing is because it takes time. It takes capital and it takes time. And I don't want to retire in 20 years. I wanted to find a way to live off the stock market gains faster. Nothing wrong against dividends. I truly believe in it, but I just think it takes time. And in my situation, I don't want to wait 20 years. But so I think this is faster. I think put credit spreads on the SPY and covered calls is faster than dividend investing. It is riskier, of course. It's more time consuming. It's less passive, but I don't mind doing it because I enjoy it. Let's just hope that it works out. But currently for 2020, this is my investment strategy. So put credit spreads on the SPY every Monday, Wednesday, Friday, 30 days out, managing winners at 50%, managing losers by selling the call spreads against it, and waiting till expiration to try to give the trade a chance to win, because it might drop below my short put, but it could by expiration come back up above my short put and become a winner. So that's why instead of closing the trade for a loser, I try to keep it open and just sell call spreads to mitigate the loss. And in my registered accounts, only because I cannot sell put credit spreads in my registered accounts, I have to look for something else. But if I could sell put credit spreads in my registered accounts, I would. Now, why, if I really like put credit spreads, why not just do everything put credit spreads and not even have registered accounts? Is because registered accounts have their benefits and I cannot ignore these benefits. Tfsa has tax-free gains. Rrsp gives me income tax credits. And Resp, I get grants from the government towards my children's education. So these are benefits that cannot be ignored. So I want to have registered accounts. And the only thing I could do is, or the best thing I could find with registered accounts is to sell covered calls on ETFs. So I take advantage of capital appreciation of the general market and I try to get more gains by, or try to generate an income from it by selling call options against it. All right, so if you have any questions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below to get up to $250 back. Thanks for watching.